Now, when you speak about unintended consequences, Andrew, but is it the macro that you're worrying about, or do you think there is a micro event risk? I mean, is that what you're alluding to? Because, you know, if you look back in the day to 2008, the macro was bad, but it was a micro event like Lehman, which actually led to the undoing of the market. Do you think as central banks tighten further and the growth concerns become larger, there could be any micro event which is lurking there, which could come as a surprise, which the market has not priced in already?
So I think there's two parts to that, Dave. One is, first of all, this is an economic recession, and probably me and you talked about this in 2000, but I don't think many people remember what an economic recession is really all about. So that's the first point. The second point is 2008 was a financial economic downturn, not an economic recession, although it caused some problems in there. So I think when the Fed increases rates, it's really the credit markets, which you could have some problems with. And that's where the micro risk comes from. And obviously, if that then spills over to the bond markets and the currency markets, you get further volatility. And that's where the unintended consequences happen. And of course, when that further exacerbates the problem about economic growth, and therefore earnings forecasts, which are still very high, in my opinion, globally, will have to be reduced even further. So that's what the market is probably not pricing in at the moment. I think the market's pricing in all the things that you've talked about previously in terms of high inflation, what central banks are going to do. But these unintended consequences, I don't think the market's yet pricing in. It's more the Goldilocks scenario, but for the time being.
So Andrew, in the light of this and in the current context, I mean, firstly, India seems to still be faring okay. We did see some numbers come in last week suggesting that perhaps retail interest is now looking a little shaky. Does that change the scenario for India at all in your books?
No, I think the retail, you're talking about the retail investor, Abhi, right? In terms of the retail investor, it's been pretty resilient, actually. It's been, I suppose, surprising to us all. In that respect. I think, though, one of the things that was mentioned at the beginning is that no one's made any money in the past, I think, probably last year and a half now. And particularly if you're below the kind of index, you're definitely losing money. So I think patience will run out, particularly if there's another downturn in the market. I think that will shake out quite a number of retail investors, from where they are today in terms of doing their kind of investments. I think what we've seen in the last 6 months, depending on kind of which tweets you look at, a lot of people were making money in options and trading, and that's really kind of disappeared now. I think people have lost quite a bit of money on both accounts, and I think the message went from I can't, I'm making lots of money to when will the market stop falling. So I think that's where we've moved to. Which isn't a bad place to be, but I think any more downturn in the markets will probably have these investors run to the shelters.
From an absolute point of view, Andrew, how much downside do you see to this market? Because, I mean, as I was saying earlier, this has been fairly orderly. Of course, mid-caps have fallen 30% in many cases, but if you look at the headline index, which is still a very large part of the overall market cap of India, but the fall is barely 15–18%, which for a bear market is very low. Do you see a possibility of another 10–15% kind of an index downside before the year is out, or before we get to that October period you're talking about?
So if we had another down leg for whatever reason, again, and let's say that takes global markets down, our feeling is that the S&P is probably maybe 10%, could see another 10% fall. We think our market could probably take a 5% fall. So we're around that 15,000 Nifty level. Now, obviously, they'll all be, it could overshoot on the downside as well. But I think anything towards 15,000 is a good time to deploying cash. And one of the things we've been doing throughout the year and saying is that, expect volatility, and therefore cash as an asset class is not a bad place to be. When you have a lot of volatility, it's always good to have money ready to go back into the markets rather than taking volatility in the short term. So I think we're moving past that phase. There could be, as I said, one down leg to the markets if some of those unintended consequences we talked about do appear. But if not, today we will be in 6 months' time. I think we'll be higher than we are today.